special voice is joining us now. Someone whose opinion actually matters across all buy-side institutions, and that is Rajat Rajgarhia, who is joining us from Motilal Oswal. Of course, he heads the institutional desk at Motilal Oswal. Rajat, thank you very much for your time this afternoon. We haven't spoken for long, so a lot to cover. Talk to us about what kind of conversations are you having right now across your clients among large institutions. The flows seem to be suggesting that buying is very good. Is it outright buying or is it hesitant buying which is happening?
Hi Ajay, good to hear from you and wish you and everyone at ET Now great celebration and congratulations for the 14th year. So, when we engage with our clients, the common discussion is that while the markets seems to be moving towards a new high, this has been a long range for the Nifty now for almost 18 months. 16,500 to 18,500 is where the markets have been trading now. And this would be the third or the fourth time when we are again making an attempt. Hopefully we will cross it this time because globally, if you look at a lot of the markets are very strong. Important to note, Ajay, here is that this year, while we tend to believe that India is moving towards a new high, year to date, Nifty is up just 3 to 4%. When you look at markets like Japan, they are up 30%. Markets like Korea, Taiwan, they are up 15 to 25%. So yes, there is a lot of positivity, but we need to break out of this range that we have been stuck for the last 18 months now.
What would be those triggers, Rajat, which would take us out? Because up till now, Indian markets, like many other globally, have been reeling under the pressure, earnings and coming under pressure, macros going out of whack, and the interest rate hike cycle actually casting a lot of pressure, and inflation, of course. You see all those triggers reverse in the next 18 months?
Well, I don't think that rates are going to reverse anytime soon, but I think there's a consensus that they have peaked out right now. That is one. But I think we are in that very sweet spot right now where, again, suddenly you have both the offshore and the domestic investors both being buyers at the same time. Generally, we always believe that the domestic investors buying always provides a big support to the market. But whenever you have the kind of offshore flows that we have seen in the last 2 months, they always takes the market up, like the way we have seen from a 17K to almost like an 18.5 plus K now in the last 1 month or so. I think the most important parameter for us in the very, very short term is how this monsoon is going to pan out. Because whatever weather forecasting agencies globally have been talking about, and considering that at least in the near term, the sensitivity is high. So people are going to see how monsoons are going to pan out. And second, if globally markets will keep making high, then the kind of money flow that we are seeing from offshore will also help our markets break out of this range.
Rajat, I want to understand the relationship and also the cause and effect. If 6 to 8 months far out, after this pause gets over and the way macro data is deteriorating, the chances and probability that inflation beast will be tamed are very high, even if it is far out and central bankers are conservative and start cutting the rate cycle. Once the cycle starts, whenever it does, how will it affect the listed universe, the valuation, and also the earnings quality of Indian ecosystem?
So Ajay, right now the markets are cheering that we are through with the rate hike cycle, right? But I don't think that we are looking at a rate cut cycle anytime this year. It probably could be only in the first half of next calendar year, if it were to begin. But I think the more important thing here is markets which have been in a consolidation mode now for quite some time, right? They have taken comfort from the fact that at least rates are not going to be raised anymore, right? Suddenly, that whole euphoria has shifted back to the equities, right? And even if rates were to remain at the elevated level for the next 2 to 3 quarters, right? The expectation that sometime soon you are going to be into a rate cut cycle, are going to drive the valuations for the sectors which typically benefit from any rate reversion that were to happen in the next calendar year. So that's why if you look at this market, financials or an auto or many of the domestic cyclicals, they are the one who are leading these markets higher versus some of the global names like an IT or others, which are still not participating in the overall up move in the last few months.
What are your thoughts on broader markets? I mean, for example, even mid cap may have made a back to a new high, but small cap index is still 15% away. How do you see these pockets in terms of valuations versus froth?
So I think, Ajay, we are going to see a lot more excitement in the broader markets, right? Because we are still into that phase where many sectors are now getting well represented in the markets, either through listings or you are at least seeing the small and the mid cap. I'm not just talking about from the market cap point of view. I'm talking from the business opportunity point of view. Look at some of the structural themes which are emerging. Post-COVID, hospitals has started becoming an allocation sector rather than just a one-stop sector now. You have QSR, you have EMS, many of these contract manufacturing companies. A lot of these companies, people believe, have a runway of growth for the next 5-10 years. And whenever you have structural stories coming out, in the initial part of the move, valuations will always look high. But if your growth were to play out well over a 5-10 year period, you will still compound very well into each of these names. So these becomes the more longer term theories, longer term stories, right? And then you have sectors which after some kind of you can say an adverse environment are making a big recovery. I would think autos, NBFCs probably fall in that bucket where their outlook because of the macros becoming more favorable looks very promising when you were to look at investing from the next couple of years point of view.
When you say NBFCs, which part do you think? Microfinance companies, or is it digital data backed kind of companies, or is it the traditional housing finance? What do you term as more attractive right now within NBFCs?
Look, within NBFCs, I think the two space where we are a lot more constructive today, first is of course the auto NBFCs, right? Because as I mentioned that autos and NBFCs are the two sectors which are recovering well. And within NBFCs, the one who are focusing on autos will tend to do well. And I think the two other segments in NBFCs, one is one who have cracked the code of this entire SME lending without compromising much on the credit quality. And microfinance, I think just because they have taken the bulk of the pain till just a quarter back. So you will suddenly start seeing the cycle reversion happening from very high credit cost. They may get into a phase in another couple of quarters where the credit cost can just collapse for them. So that will at least make cyclicality wise the numbers and the ROEs look very high.
Outstanding. Rajat, so nice to be chatting with you. Thank you so much for your time. I'll definitely come down and have a longer chat with you over a coffee. So much to learn from you, like always. Thanks a lot for your support over the years.
Have a good time.